Stop everything right now. Close every other tab. What I'm about to tell you happened between 11:47 p.m. Eastern last night and 4:15 a.m. this morning while you were asleep. And the financial media will not cover this. They can't. Because if the general public understood what just transpired in the physical silver market in the last 12 hours, there would be riots outside every bullion bank from London to Manhattan. I have in front of me an internal memo that was leaked from a mid-tier futures broker in Chicago. The document is dated January 8, 2026, 6:32 p.m. Central Time. The subject line reads, Emergency Liquidity Protocol, Physical Delivery Obligations. This memo was not meant for your eyes. It was sent to exactly 17 institutional clients who are currently short physical silver contracts on the COMEX. And the language in this memo is not the language of business as usual. This is the language of panic. The price you're seeing on your screen right now, whatever number is flashing on Kitco or Bloomberg, that is a lie. That is a computational artifact. That number represents the price of a promise, the price of a piece of paper that says someone, somewhere, will deliver you silver. But here's the problem. The paper market just collided with physical reality, and physical reality doesn't care about your margin account. Listen to me very carefully. In the past 72 hours, the spread between paper silver spot price and physical premiums paid by actual humans trying to take delivery has exploded to levels I have never seen in my entire career. We're not talking about the usual $2, $3, $4 premium overspot that you might pay at your local coin shop. We are talking about premiums that have blown out to $11, $14, in some cases $17 per ounce over the COMEX settlement price for immediate delivery of physical metal. Let me translate that for you. The paper market says silver is one price. The real world, where actual silver changes hands, is saying it's worth $15 more per ounce. That is not a market. That is a fracture. That is the sound of a system breaking in real time. Now, you need to understand what's happening structurally. The COMEX, the Commodities Exchange in New York, where silver futures are traded, operates on a two-tier inventory system. There's registered silver, which is available for delivery against futures contracts, and there's eligible silver, which is in the warehouse but not available for immediate delivery unless the owner decides to reclassify it as registered. As of the January 7th warehouse report, total registered silver at the COMEX stood at 47.2 million ounces. Total eligible was 243.8 million. Now those numbers sound big. 47 million ounces of registered, that's available for delivery. But here's the problem. Open interest, the total number of futures contracts that could theoretically demand delivery, represents 892 million ounces of silver. Do the math. That's a coverage ratio of 19 to 1. For every actual ounce of silver sitting in the registered category ready to be delivered, there are 19 ounces worth of claims on paper. This is not a conspiracy theory. These are the exchange's own numbers published on their website every single day. The entire COMEX silver market is a fractional reserve bullion bank, and the fraction just got a lot smaller, because here's what happened overnight. Between the close of trading yesterday and the overnight session in Asia, something broke. We saw a flood, and I mean a flood, of delivery notices filed for the March contract. Normally you'd see maybe 300, 400 contracts stand for delivery in a given month. Institutional players roll their positions forward. They don't want the metal. They want the trade. They want the leverage. They want to speculate on the price movement. But not this time. As of 4:00 a.m. Eastern, we are seeing preliminary notices for over 2,100 March contracts standing for delivery. That's 10.5 million ounces of silver that somebody, somewhere, is demanding be delivered to them in physical form in the next 60 days. And those numbers are not final. The notice period doesn't even close until next week. Now let me explain why this is a nuclear event. Those contracts are being held by entities who are not the usual suspects. This is not some hedge fund in Greenwich rolling a speculative long position. The pattern of filings suggests industrial offtake. We're talking about entities who need the metal for production. Samsung, LG Chem, Panasonic, the lithium-ion battery manufacturers who are scrambling to secure conductive materials because the electric vehicle mandates in the EU and California are no longer theoretical, they are law. Solar panel manufacturers who need 20 grams of silver per unit and are facing supply chain choke points out of China. These are not traders. These are end users. And when an industrial end user stands for delivery on a COMEX contract, they are not bluffing. They need the silver or their factories shut down. This is not a financial trade. This is a supply chain emergency disguised as a futures market transaction. And on the other side of that trade, you have the shorts. You have the bullion banks, the market makers, the entities who sold those contracts assuming they'd be rolled, assuming they'd be cash settled, assuming the buyer would take the profit and walk away. But the buyer is not walking away. The buyer is saying, deliver the metal. And this is where it gets interesting. Because if you're a bullion bank and you're short 200 contracts, that's 1,000,000 ounces, and you don't have 1,000,000 ounces sitting in a vault with your name on it, you have three options. Option 1, you go into the physical market and you buy 1,000,000 ounces at whatever the asking price is. But the physical market right now is tight. Dealers are quoting 4 to 6 week delays on large orders. Premiums are vertical. The metal is not available at spot. So if you're buying to cover a short, you're not paying 29 an ounce. You're paying 41, 43, maybe more, depending on the size of the order and the urgency. Option 2, you convince the longs to roll their contracts forward by offering them a financial incentive. You pay them to not take delivery. But here's the problem. If the long is an industrial user who needs the metal for Q2 production, they can't be bought off. They don't care about your incentive payment. They need the silver or their production line stops, and they breach their own contracts with Tesla or Samsung or whoever's waiting for their battery cells. Option 3, you default. You tell the exchange you cannot deliver, you post cash settlement, and you eat the penalty. But if you do that, you just admitted to the entire market that the COMEX is not a physical delivery market. It's a cash settlement casino where delivery is optional. And once that credibility is gone, the entire futures complex collapses because nobody will ever believe a COMEX price again. So what's happening right now, in real time, is that bullion banks and brokers are scrambling to source physical metal to meet delivery obligations they never thought they'd have to meet. In the memo I referenced at the top of this video, the leaked document from the Chicago broker, it explicitly uses the phrase emergency liquidity protocol. That is not standard language. That is the language you use when the normal mechanisms have failed. The memo instructs clients who are short March silver to evaluate all available physical inventory sources, including but not limited to eligible warehouse reclassification, off-exchange settlement with approved counterparties, and extraordinary premium procurement. Translation: find the metal anywhere you can, pay whatever you have to pay, and do it quietly, because if the market figures out how desperate you are, the price will go parabolic before you can cover. Now let's talk about what's driving the demand side, because this is not just a COMEX quirk. This is a global physical shortage manifesting in multiple markets simultaneously. In London, the LBMA, the London Bullion Market Association, which is the other major global silver trading hub, physical silver available for immediate delivery has dropped to the lowest level since the COVID lockdowns in 2020. We're talking about inventories that are down 42% year over year. In Shanghai, the Shanghai Gold Exchange, which also trades silver, reported a drawdown of 187 tons of physical silver in the last 11 trading days. That's 6,000,000 ounces withdrawn from the exchange vaults in less than 2 weeks. Where's it going? It's going into manufacturing, it's going into private vaults. It's being moved by entities who do not trust the paper market to deliver when they need it. And then there's India. India is the world's largest consumer of physical silver for jewelry, industrial use, and investment. The Indian import data for December just came out, and it shows silver imports up 91% compared to December 2024. That's 140 tons of silver imported into India in a single month. Why? Because the Indian dealers see what's coming. They see the tightness. They see the premiums rising in Europe and North America, and they're front-running the shortage by importing now before the price disconnects completely from the paper market. What you are witnessing is the end of the paper-silver paradigm. For 40 years, since the Hunt brothers tried to corner the silver market in 1980, and the CFTC changed the rules to stop them, the price of silver has been determined not by supply and demand for physical metal, but by the buying and selling of leveraged paper contracts on the COMEX and the LBMA. The bullion banks could short unlimited quantities of silver because they knew the longs would never take delivery. It was a gentleman's agreement. You trade the volatility, we provide the liquidity, and nobody asks for the actual metal. But that agreement just ended. The industrials are asking for the metal, the battery manufacturers, the solar companies, the defense contractors who need silver for missile guidance systems and radar components. They are all standing for delivery simultaneously. And the bullion banks are discovering that there is not enough physical silver in the world to satisfy even a fraction of the paper claims outstanding. Let me give you the napkin math, because this is simple and it is devastating. Global silver mine supply in 2025 was approximately 843 million ounces. That's the total amount of silver pulled out of the ground by every mining company on planet Earth. Sounds like a lot, right? But here's the problem. Industrial demand alone, not investment demand, just the silver used in manufacturing for electronics, solar panels, batteries, medical devices, water purification, all the applications where silver is consumed and not recycled. Industrial demand in 2025 was 682 million ounces. That leaves 161 million ounces of newly mined silver available for everything else: coins, bars, jewelry, silverware, and investment demand. But investment demand in 2025, according to the Silver Institute, was 329 million ounces. The math is broken. There is not enough newly mined silver to meet industrial demand and investment demand. The difference has to come from above-ground stockpiles recycling or drawdowns from exchange inventories. And the stockpiles are being drawn down. The recycling is maxed out, and the exchange inventories are now being demanded for delivery. This is not a temporary squeeze. This is a structural deficit that has been papered over for years by the derivatives market, and the paper just stopped working. Now, let's talk about the enemy, because there is always an enemy in these situations, and the enemy today is JP Morgan Chase. For over a decade, JP Morgan was the largest short position in COMEX silver. They were the house. They were the entity that would sell unlimited paper silver to cap the price anytime it tried to rally. They were fined, they were investigated, they were accused of spoofing and market manipulation, but they never stopped. Until they did. In 2020, quietly, JP Morgan flipped. They stopped being short. They started accumulating physical silver. They moved over 200 million ounces of physical metal into their own warehouse vaults. They went from being the largest paper short to being the largest physical long. And now, in January 2026, JP Morgan is sitting on the largest private stockpile of physical silver in the Western Hemisphere, and they are not selling. Why? Because they know what's coming. They spent 10 years suppressing the price, accumulating the metal at artificially low prices, and now they're going to watch the other bullion banks, the ones who stayed short, who kept playing the paper game. They're going to watch them get obliterated trying to cover their shorts in a market with no physical metal available. This is not a conspiracy. This is strategy. JP Morgan built a silver fort, and now they're going to defend it while the rest of the market burns. And the rest of the market is burning. Scotiabank, one of the legacy bullion banks in the COMEX silver market, just announced they are exiting their metals trading business entirely. That announcement came out last week. The official reason given was strategic realignment. The real reason is they can't manage the delivery risk anymore. They can't maintain the short positions in a market where clients are actually demanding physical metal. So they're shutting it down, they're unwinding their book, and they're walking away. That is not a vote of confidence. That is a retreat. HSBC, another major player, has reportedly restricted new short positions in silver for institutional clients unless the client can demonstrate physical inventory to back the trade. That is unprecedented. That is the bank saying, "We will not let you sell silver you don't have, because we don't trust that we can source it if you get called." What you're seeing is the infrastructure of the paper silver market collapsing in real time. The banks are backing away. The brokers are panicking. The exchanges are tightening margin requirements and delivery protocols. And the price, the official COMEX price, is barely moving because the algos and the futures traders haven't figured it out yet. They're still trading the chart. They're still trading the technicals. They don't understand that the chart is no longer connected to reality. But the physical market understands. Go to any major bullion dealer's website right now. Look at the premiums. Look at the delivery times. You will see American Silver Eagles quoted at 13 to 15 over spot with a 6-week delivery window. You will see 100-ounce bars at 8 over spot if they're even in stock. You will see Canadian Maples, Austrian Philharmonics, all the sovereign mint coins, either sold out or available only on backorder with premiums that were unthinkable 6 months ago. This is not a normal market condition. This is a market that is bifurcating into two separate realities: the paper price and the physical price. And the gap between those two prices is the premium blowout. It's the market's way of saying, if you want the real thing, you're going to pay the real price. And the real price is not what the COMEX says it is. Now, the industrial angle is critical here, and this is something the mainstream financial media will never explain to you because they don't understand the technology. Silver is no longer just a precious metal. It is a strategic industrial commodity. It is the most conductive metal on Earth for both electricity and heat. It is irreplaceable in high-efficiency applications. Every electric vehicle battery uses silver in the contactors, the buzz bars, the circuit protection. The new solid-state batteries that Toyota and Samsung are bringing online, those use even more silver per cell. We're talking 50 to 65 grams of silver per kilowatt-hour of battery capacity. A Tesla Model 3 uses approximately half a kilogram of silver. Scale that across 20 million EVs per year globally, and you're talking about 0 tons of silver just for the EV sector. That's 320 million ounces annually for one application. Solar panels use silver paste for the conductive grid on the photovoltaic cells. The average solar panel uses 20 grams of silver. The global solar industry is installing 400 gigawatts of new capacity per year. That's 130 million ounces of silver per year, just for solar. And that number is growing because the EU and China are racing to hit their renewable energy targets. And every single one of those solar panels needs silver. Then there's the military. The defense industrial base is consuming silver for radar systems, missile guidance, avionics, unmanned systems. The Pentagon doesn't report how much silver it uses, but the contracts are public. Lockheed, Raytheon, Northrop, they're all buying silver through intermediaries, and they're not buying it on the COMEX. They're buying it through private deals with miners and refiners because they cannot risk a supply disruption. What this means is that industrial offtake, the amount of silver being consumed and removed from the market permanently, is accelerating. And unlike investment demand, which can reverse if the price goes too high, industrial demand is inelastic. If you're Samsung and you need silver to build battery cells for a contract you signed with Ford, you don't care if the price is 30 an ounce or 50 an ounce. You need the silver, or you breach the contract and you lose the client. So you pay the price, and that's what's creating the delivery squeeze. The industrials are competing with investors for a finite supply of physical metal, and the industrials have deeper pockets and stronger incentives. They will outbid the speculators every single time, because for them, this is not an investment, it is a production input. They need it like they need copper, like they need lithium. It's a material cost, and they'll pay whatever the market demands. So where does that leave you? Where does that leave the individual investor who owns physical silver or who's thinking about buying? Let me be very clear about what's going to happen in the next 30 to 60 days. The bullion banks are going to attempt to engineer a price smash. They're going to try to scare you. They're going to dump paper contracts in the overnight session. They're going to trigger stop losses. They're going to get the algorithm traders to pile on the short side, and they're going to try to drive the price down fast and hard to shake out weak hands. Why? Because they need you to sell your physical metal. They need supply. They are trapped. They have delivery obligations they cannot meet. And the only way they can meet them is if they can buy physical metal from somebody. And the easiest target is the retail investor who panics when he sees the price drop 5% in an hour and decides to sell at a loss. Do not fall for it. The price you see on the screen during one of these smashes is not the price you'll get if you try to sell your physical metal. Call your dealer during a paper price smash and ask them what they'll pay you for your silver eagles. I guarantee you the bid will be nowhere near spot. It'll be spot plus a premium because the dealer knows the physical market is tight and he can resell that metal immediately at a profit. The paper market is a psychological operation at this point. It's designed to create the illusion of supply, the illusion of liquidity, the illusion that silver is cheap and plentiful. But the physical market tells the truth. And the truth is that silver is scarce. It is being consumed faster than it's being mined. And the people who need it for industrial use are willing to pay a lot more than 29 an ounce to get it. You need to understand that we are entering a phase where the spot price becomes irrelevant. What matters is the physical premium. What matters is whether you can actually get the metal delivered to you, and at what price. And right now, the premium is exploding because the market is repricing silver from a speculative commodity to a strategic resource. This is the same thing that happened with palladium in 2019 and 2020. Palladium is used in catalytic converters for cars. When the emissions regulations tightened and every car manufacturer needed more palladium per vehicle, the price went from 1 0 an ounce to 3 0 an ounce in 18 months. The industrial users drove the price vertical because they had no substitute. They needed the metal, or they couldn't sell cars. Silver is palladium on steroids. It has more industrial applications, a smaller market, and a larger short position. The setup is bigger, the leverage is higher, and the potential for a price dislocation is extreme. We're not talking about silver going to 40 or 50. We're talking about a scenario where the paper market breaks completely, where the COMEX stops being the price discovery mechanism, and where physical silver trades at whatever price clears the physical market, regardless of what the futures contracts say. And when that happens, you will not be able to buy physical silver at any reasonable price. The dealers will be sold out, the mints will be rationing, the wait times will be measured in months, not weeks. The premiums will be 20, 30, 40 over whatever the paper spot price is, assuming the paper market even still exists. This is why I keep saying, the price on your screen is a lie. It's a historical artifact. It's the last quoted price of a contract that may or may not be deliverable. The real price, the price that reflects the actual supply and demand for physical metal, is being discovered right now in the premium market, in the backwardation spreads, in the desperate phone calls that brokers are making.